Gold just touched $6,000 an ounce. Let that sink in. Not on New York, not on London, not during regular trading hours. Gold printed $6,000 in Chinese weekend trading while every major Western exchange was closed. That's a $750 gap above Friday's close in a single weekend as geopolitical tensions exploded. And that is not even the most important signal flashing red right now. A regional Chinese bank, Zheshang Bank, issued an official notice warning customers that due to extreme volatility and tightening liquidity, it may suspend gold savings accounts, including buying, selling, and physical exchange. A commercial bank in the world's second largest economy is preparing to halt gold transactions because supply inside its system is thinning. That is not a routine correction. That is stress inside the financial plumbing. Tonight, I'm going to break down exactly what happened, why gold repriced so violently, why silver may be even more vulnerable, and what this means as global markets prepare to reopen. Stay with me, because when paper markets catch up to physical reality, the move could be historic. What just happened? Over the past several days, geopolitical escalation in the Middle East intensified rapidly. Reports confirmed that Ali Khamenei, Iran's long-serving supreme leader, was killed in a coordinated strike attributed to the United States and Israel. The confirmation was publicly acknowledged by Donald Trump, who framed the operation as decisive and strategic. This was not a limited tactical exchange. This was a leadership decapitation. Simultaneously, Iranian retaliatory missile launches targeted multiple Gulf locations. A U.S. naval installation in Bahrain reportedly sustained impact. Air traffic disruptions rippled across parts of the UAE. Regional governments moved to emergency footing. Markets do not wait for historians. They reprice instantly. Gold did exactly what it has done for 5,000 years during systemic stress. It absorbed capital seeking safety. Why $6,000 matters. $6,000 is not a forecast. It is a transaction price paid in real time while Western exchanges were offline. When major venues like COMEX reopen, they must reconcile that $750 weekend gap. Market makers will widen spreads. Liquidity will thin. Short positions established near $5,200 to $5,500 are suddenly underwater. That creates a reflexive cycle. Gap higher, margin calls, forced buying, further upside pressure. That's how squeezes accelerate. Now layer on top of that a commercial bank signaling potential physical constraints. When a bank prepares to suspend gold activity due to inventory pressure, it reveals stress in the supply chain, not in speculative futures positioning. Paper contracts can multiply infinitely. Physical metal cannot. Why silver could be more explosive? Gold's current surge is primarily demand-driven. Silver's situation is more complex and potentially more volatile. Silver is a monetary metal, a critical industrial input, a defense sector material, a renewable energy component. Missile guidance systems, electronics, solar panels, communications equipment all require silver. Unlike gold, silver operates in a structurally tighter market. Mine development takes years. Above-ground inventories are smaller. Export restrictions and regional mining disruptions were already pressuring supply before any escalation began. If capital floods into precious metals while industrial demand remains firm, silver does not just experience a demand spike, it experiences a dual pressure event. Historically, during acute crises, the gold-to-silver ratio compresses rapidly. At 6,000 gold, even a modest ratio compression implies significantly higher silver pricing. That is arithmetic, not speculation. The energy multiplier. Now let's talk about the Strait of Hormuz. Roughly 20% of global oil supply transits through that narrow corridor. Iran does not need to formally close it to disrupt pricing. Insurance premiums alone can reprice crude. Even a partial risk premium could send oil sharply higher. Energy inflation feeds transportation, transportation feeds food, food feeds consumer inflation. This complicates central bank positioning dramatically. The Federal Reserve was already navigating inflation persistence. Add a geopolitical energy shock, and policy flexibility narrows further. Gold thrives when monetary authorities appear constrained. The nuclear variable. Strategic analysts are openly discussing escalation thresholds, including the possibility of nuclear signaling. Whether that occurs is uncertain, but markets price probability, not certainty. If escalation crosses into weapons of mass destruction territory, sovereign funds, central banks, and institutional portfolios would likely accelerate diversification into hard assets. In that environment, gold at $6,000 would not represent a peak. It could represent a transition point. When markets open, here's the reality. Gold closed near $5,250. Weekend trading printed $6,000. That gap must reconcile. If institutional capital enters simultaneously at the open, liquidity pockets could disappear quickly. Silver, given its smaller market depth, could move even more violently. This is not about chart patterns right now. This is about systemic repricing under geopolitical stress. For long-term holders, if you allocated to precious metals as portfolio insurance, this is precisely the type of environment those allocations were designed for. Volatility will be extreme. Expect sharp intraday swings. Expect rumor-driven reversals. Expect algorithmic whipsaws. But structural drivers, geopolitical instability, energy risk, central bank constraints, and physical supply strain have intensified, not diminished. For investors on the sidelines, every major breakout in gold historically felt too expensive at the time. At $2,000, it felt stretched. At $3,000, it felt excessive. Now, at $6,000 in off-exchange pricing, the conversation shifts from, is it expensive, to what is the new baseline? I am not here to tell you what to buy or sell. I am here to interpret signals, and the signal is clear. The physical market repriced before the paper market had the chance to react. The bigger picture. In 5 days, high-level nuclear talks collapsed. Regional strikes escalated. A head of state was eliminated. Missile exchanges expanded. A commercial bank flagged gold supply strain. Gold printed $6,000. There is no modern parallel for this exact combination of geopolitical acceleration and financial repricing. This is no longer a routine macro cycle. This is systemic recalibration. And in moments like this, investors ask one fundamental question. When uncertainty spikes globally, what asset carries no counterparty risk? Right now, the market's answer is visible in that $6,000 print. If you want real-time, data-driven analysis as this situation develops, including what to watch when futures reopen, how silver positioning could evolve, and what signals confirm continuation versus reversal, make sure you're subscribed. Like this video if you value clear, grounded financial analysis without hype. Subscribe for in-depth breakdowns you won't get from surface-level headlines. Markets are about to reopen. Be positioned with information, not emotion. I'll see you in the next update.